Hey there. Today we're going to figure out, can $1.5 million actually be enough for retirement? We're going to look at a real life case study. These are clients of mine, right? Their names have been changed, but they're newer clients and they wanted to retire early. Now on paper, they're doing everything right. They have good jobs, making close to $100,000 or more each, good savers with over $1.5 million accumulated in investable assets, both maxing out their 401k, they're empty nesters now, their house is being close to being paid off, no other debt, but they didn't want to retire at 61. And so what we're going to figure out in today's video is, can they afford to do that? You can imagine what's going on in their head. I hear this all the time. Ready to retire. I want to start living my life for myself. There's things, causes, purposes, organizations that I want to get back to, I want to get involved in, and I don't want to waste away at this desk, right? They want to start doing the things that they love. But that's also when the buts start creeping in as well. But I still have a mortgage. But what about healthcare? What about if I want to travel more or do a home remodel? Or what if the market goes down, right? Do we really have enough for a long retirement? If you don't know me, my name's Nick Covio, certified financial planner with Swell Financial, where we help our clients minimize their taxes, prepare for retirement, and simplify their investments to align to live a life that's consistent with them and their needs. So we're going to dive into this video and we're going to show the different options of what makes retirement possible. All right, let's get started. All right, so let's take a look at Jack and Michelle. Like I mentioned, they've done everything right. But now the question is, can they afford to retire early? So they have $1.5 million saved and accumulated. That comes from their cash and savings, their 401ks, their Roth IRAs, and a brokerage account. We can see from Jack and Michelle, they're doing a great job by all measures. When we look at this, we could start to dive into some of their metrics, okay? They're age 61. They want to retire, right? They came in my office wanting to retire next year, okay? They have kids. We've modeled out their life expectancy well into their 90s. Each of their parents, one on each side, still living, right? So there might be a potential inheritance there. We talked through what's a priority to them. And so when we start to look at some of the variables, we could see they're making a really good income. You know what? They're saving a lot of it as well, right? So they have a very comfortable standard of living, and they're also able to today max out their 401ks, contribute more to a brokerage account. So the question we ask ourselves is, can we continue our living style day one of retirement, right? Research suggests, right, and I'll put it up here on the screen in just a second here, we have 3 different phases of retirement. We have the go-go years, the slow-go years, right, and the no-go years. And what research suggests is that we're generally speaking, we spend about the same in retirement as we did on our very last day of work. We're the same people, right? Maybe we go to the same restaurants. We order the same things off Amazon. We go on the same vacations. If anything, going into retirement, those early years, known as the go-go years, and you can see here on the chart, we're going to spend actually more going into retirement because you're going to want to travel. You're going to want to do fun things. You're going to want to spend money on something you've been saving up or envisioning or picturing for a really long time, right? And then as we get into our deeper tier of retirement in our late 70s, early 80s, we tend to not travel as much. And so we'll look at some of the cash flow projections and what we can afford to retire. So now that we have that information, what we want to go ahead and do is test the plan. Can Jack and Michelle actually afford to retire? You're going to hear me say this a couple more times on this video. Retirement is all about giving yourselves options. Remember, retirement plans, they don't fail, they just simply adjust. So let's go to the board, see what they can afford to do and if it's realistic or not, and then we'll dive into the numbers. All right, so let's look at the numbers here. Here's their current situation. Now, I know there's a lot of things on the screen. We're just going to go through this one by one. Now, top left here, what you're going to see, my left, probability of success. It's another fancy way of saying Monte Carlo simulation. Okay, what we're looking at here is when we run Jack and Michelle's situation, age 61, $1.5 million, a mortgage that's almost paid off. When we run that through a blender of 1,000 different market simulations, right? Simulations such as what happens if they retired just before or just after the 2008-2009 great financial crisis? What about during COVID? Right? And so what we want to do is, how many times are these plans successful? And again, it's not whether it's pass fail, it's how many times do we actually have to make a course correction, right? A slight adjustment. So when we look at the current situation, this gives us some really good feedback, right? Remember, they communicated to us that they wanted to spend the exact same amount of money as they are doing today, right? That's well over $10,000 a month. They want to retire today and they want to maintain their standard of living. One of the things that we looked at and said, okay, what's most important to you? Is it an early retirement or is it living life to the fullest, right? So when we look at these numbers here, we're going to ask Jack and Michelle, what is actually the most important thing to you? What is the single most important thing? Is it retiring today, not returning to work, being able to go on vacation? Is that the single most important thing? And would you be willing to make some sacrifices to make that happen? Or number two, do we want to work a little later so that we don't have to make any sacrifices, right? So it's a both and, right? And we want to figure out when we're going through retirement planning, what is the most important thing? Do we want to have that longer retirement where we're going to have to cut some expenses? Or do we want to work a little later? And that doesn't mean staying in our job, right? Retirement plans, you heard me say, it's all about giving yourself options. So does that look like walking away from your current job and now getting the opportunity to do something that you've always wanted to do, right? For me, I'm a huge, and probably at some point I'll have some more things in the background here, but I'm a diehard Pittsburgh Steelers fan. One day I would love, right, to be a season ticket holder, but also work for them, right? Collecting tickets, working concessions, living and breathing, getting a chance to do that, right? And still getting paid to do something that I enjoy, or being a national parks guide, something like that. And so it's all about trade-offs. So when we look here at the screen, what we could see here is, hey, based on what we're seeing today, at age 61, retiring next year, it doesn't work. We're going to have to make some changes, okay? So then we run a report called, okay, well, if we want to retire today, what is the most amount that we could spend without putting our plan in jeopardy? And that comes back to somewhere around $6,000 a month. Well, that's a big difference than living high on the hog at $10,000 a month. Now, keep in mind these expenses or these numbers are pure living expenses. This is after taxes, adjusted for inflation. So $70,000 today, it's going to be $70,000 20 or 30 years from now. $70,000 is, of course, going to increase, but it's going to be worth the equivalent amount. Okay. We also want to build in some long-term care costs and some annual travel. Okay. These are additional and separate expenses. We want to make sure we hedge for living expenses later on in life. And so what we can see here is with a higher degree of confidence, we could actually make that happen. Now, what happens if they push retirement out 3 or 4 more years? Well, now we could spend close to $8,000 or $9,000 a month, and it's no problem. So what we're going to do now is take a look at our other software. What we like to do now that we've figured out that Jack and Michelle, with a high probability of success, are going to be fine during their retirement, depending on which path they pick. We want to answer the more important question, which is how much can they afford to retire? Remember, we're going to probably, Jack and Michelle, going to spend more money, it's likely, early in their retirement. And so what we want to be able to do is give them that number of, hey, with a high degree and confidence of success, here's how much you can spend. And what you'll see on this software here is as markets change, because we know they go 3 ways, right? Up, down, and then sideways. And so when the market changes, when it moves, it's going to be really important for us to figure out how much can you spend. So what we're looking at here on this screen is if Jack and Michelle want to retire early, they're going to have to need some cuts, right? Anytime we see this red here on the screen is telling us, got to cut back a little bit because we're taking too much from retirement, right? We're drawing too much from our portfolio that's not going to last us. And then what we're going to see here, and I'll dive into this in a different scenario, but looking at the middle of the screen with income adjustments, one of the theories that we ascribe to here at Swell Financial is what's called the guardrails approach. Rather than just our standard take 4% out, adjust for inflation, take 4% out, adjust for inflation, right, in perpetuity, we like to be able to look at, hey, if the market's doing really well, can we afford to give ourselves a raise? Or if it does really poorly, like we saw in 2022 and 2020 and 08, 09, well, we may run out of room if we continue to spend the exact same amount. So what does it look like maybe just temporarily to postpone that vacation or not make that big purchase or just tighten up? Remember, retirement plans, they don't fail. They just simply adjust. So how can we make adjustments along the way to give us success long term? Okay, so when we change the screen here, what we're going to see is, okay, we have 2 different options, right? We want to delay retirement or spend less. Well, Jack and Michelle, they really want to retire. So I said, Nick, hey, what is possible? I said, okay, well, what if we decreased our spending from 10, 11 grand a month down to somewhere between 8 to 9 that still gives us a really healthy amount just to go out and spend. Still takes into consideration travel and your mortgage and those types of things. And so we could see whether it's retiring earlier and living off less or working a little longer. What you could see now is, wow, we could spend $11,000, almost $12,000. Again, that's net, right? Being able to look at, okay, well, with taxes, that's $15,000 we're taking out of our portfolio early on. Now, you may be asking yourself, where is that money coming from? How is it allocated, right? Stocks to bonds. And that seems like a really high number. Is that going to change throughout the course of our lifetime? And absolutely, right? We talked about it earlier with the go, slow go, no go years. This model assumes that we're not going to spend the exact same amount in perpetuity for our entire lives. In fact, we're going to spend a lot more. Maybe it's traveling. Maybe it's gifting our kids a certain amount of money so that they can live a lifestyle that you want to see them live, whether it's buying that house, paying off that college debt, so on and so forth, right? That's the die with zero approach. What we're going to see is we're spending a lot more early in retirement, right? And as we get into our late 70s, more so the 80s and 90s, right? Spending tends to slow. And then we see an uptick here, right, in our final years for long-term healthcare costs that we want to be able to factor and model in. So now that we know how much Jack and Michelle could spend, what we want to do is run that through our cash flow report, because it's a simple formula in retirement, right? We have what's called the safe, sustainable distribution rate. And one of my favorite studies, and there's a couple different ones, but this one's what's referred to as the Trinity study. And it tells us, depending on our retirement timeline, how much we can draw from our portfolio. That's what's known as our withdrawal rate, right? And we see 3%, 4%, 5%, so on and so forth. And then going over to the horizontal column, what we see here is, well, how is our portfolio balanced, right? How is it allocated between stocks and bonds? And what we want to be able to say here is, well, for Jack and Michelle, we wanted to be somewhere in the 30 to 25-year range, give or take, for retirement, assuming we're living to 91, 92 years old, right? And so we want to stay somewhere in that, you could see 3 to 5% distribution space. And we know that these numbers are more so static, and we're going from the guardrail approach, meaning we may spend a little more earlier in retirement and spend a lot less later on in retirement. And it's going to be flexible and adaptable, right? But what this is telling us is two things, right? For a higher likelihood of success, we're spending less, right? So we need to know what that number is. And number two, and we'll dive into this in just a second, how we invest our portfolio in retirement, it really, really matters. And so once we look at that study and we know we're trying to stay somewhere in the 3 to 4% range, maybe even 5, depending on early enough in retirement, what we want to be able to look at is, hey, if the life Jack and Michelle are living right now, when they go to retire, how much are we taking from our portfolio? And remember, the math equation that we're trying to figure out for our withdrawal rate, right? We first want to see what sources of income we're going to have coming in. Is it Social Security? Is it a pension? Is it part-time? Is it a part-time job? Is it rental real estate? Those sources, right? We'll see how far that takes us. And whatever that amount is short from what we need every month, well, we're going to have to take that from our portfolio. And that amount is what's referred to our withdrawal rate. So you could see if they're wanting to live off of $120,000 to $150,000 a year, 12 grand a month, it gets really, really high, right? And this is okay for maybe a year or two, but this is absolutely not sustainable. Now, what does that look like if we say, well, we want to retire early and maybe we'll supplement with a part-time job? Let's go ahead and update that. Because remember, right, at least for this particular model, we're not having them take Social Security until age 67. So there's a 6-year gap from 61 to 67 where that money is going to have to come from somewhere. And the more we take from our portfolio, right, this is what's known as sequence of withdrawal risk, right? The more we take from our portfolio, right, the less we're leaving ourselves for later on retirement. And we leave ourselves susceptible to downturns in the market because now we really have to adjust to be able to withstand a long retirement. So let's go ahead and take a look at this. If they retire and we have a part-time job, well, you could start to see here, right, starting in 2027, the withdrawal rates look a lot better. 5, 5, 6. Now let's see what happens when Social Security comes, right? 0, 2.27, 2.23. Now we're getting somewhere where we could safely give them, the thumbs up. Let's take a look at, what if they wanted to retire later? Maybe they said to me, hey, Nick, you know what? I don't want to work any longer than I have to once I hang it up. Okay, well, say they retire at 67, right around the time that Social Security starts coming in, 4.7, 4.8, 4.9. You see where I'm going here? Retirement planning is all about options. You can make it harder on yourself if you need to by retiring early and not making adjustments, or we can live off less. We could work longer. And so the possibilities are endless, but we want to have the data, the science, the research, whatever you want to call it, to be able to support that. And number two, we want to be nimble enough that when bad things happen, we know the market's going to go down at some point, right? When those things happen, we need to make changes so that we could prolong our retirement. So now that we know Jack and Michelle want to retire early, we know how much they could spend at $7,000 to $8,000 a month. We need to figure out where that money is going to come from. Well, in retiring early, right, starting at age 61, we know there's that 6-year gap going into retirement before Social Security starts. So what we can see here is if they're going to retire early, it's going to cost them almost $10,000 a month to be able to get to that number. And that comes out to about an 8% withdrawal rate when we divide the 120,000 by 1.5 million, right? It's not until much later on that the cavalry's on the way with Social Security, as we showed on that slide previous, that they start taking a smaller distribution rate. So if this is really important to them and they want to retire early, well, we're going to need our portfolio to be a little more conservative to be able to reflect all that money coming out of their portfolio for those first 5 or 6 years. So what we do is we work backwards. We figure that money has to come from somewhere. So let's go ahead and safeguard. Let's put it on the shelf. Cash, short-term bonds, right? And even intermediate and longer-term bonds for those 3rd, 4th, 5th, 6th years of retirement. Because what we want to do is we want to isolate our portfolio from a market shock, right? We talked about this earlier with the sequence of return risk. If something bad happens in the market, and we know that happens on average, once or twice every 10 years. So one of the things that we want to do is protect our portfolio from a shock. We know it's not an if, but when markets crash, how are we going to respond, right? What are the things that we're going to have to do? Because essentially what we want to do is we want to remove for our living expenses any market risk. And so we need to know that every month there's going to be a paycheck for us, waiting for us in retirement. And so again, as we said, the cavalry's on the way in Social Security, but we got to plan for those 6 years where our distribution rates are higher. And as such, our portfolio needs to adapt to that. All right. So for Jack and Michelle, if retiring at 61 is really, really important to them, what we need to do is we need to first safeguard some money for living expenses. So what that's going to look like. And again, for each client, it's going to be a little subjective based off of how much cash they want to hold, right? Cash is paying a higher rate today than it was several years ago. So we're not getting penalized as much for being on the sidelines. But again, your portfolio in retirement does not need to act or look the same way as it did when you were in your 30s or 40s. It's okay to trade some upside risk, right? And missing out on the market running away like it has over the last couple of years for safety. You're playing a different game now. So being able to look at this, what we say in working backwards is saying, well, if we need $120,000, first, we're going to put some money on the sidelines. We're going to want to cover somewhere between 4 or 5 to maybe even up to 10 years of living expenses based off of cash, short-term bonds, and intermediate and long-term bonds. Because what this is allowing us to do is you see this section here in blue is it's telling us that we know, right? Remember, markets move 3 ways, up, down, and sideways. We're not touching that blue, right? And so what that allows us to do is when markets are really good, well, we can move some of the money from the blue to backfill our living expenses and replenish, right? We know markets on average have more good years than they do bad years. Now, when those bad years occur, what we want to do is we want to leave it alone because the number one risk that we can put to our retirement is by being forced and being in a situation, right? Being forced to sell to cover our living expenses when markets are down. Because when we sell, when markets are down 20 or 30%, we have just robbed our stocks from ever getting the opportunity to recover. And so what we want to do is find a balance. Now, what you're going to see on the next slide here, which is really cool, is when the cavalry comes and we have Social Security on the way, look what happened bottom right here to our cash flow need. We now have $6,500 a month coming in from Social Security, which now means we don't have to spend so much. So you saw on the slide previous that I shared, your distribution rate changes over time. And what this also reflects is that if we no longer need a larger portion of the money each and every month, well, we can afford to take on more risk, right? We can go from 50-50 to 60-40, somewhere in there. Again, it's all based on your living expenses and your ability to take on risk. But the point of the matter here is that when our lifestyle changes, when new cash comes in, whether it's Social Security, a part-time job, we don't put as much reliance on our portfolio. Now that we've figured out how much Jack and Michelle can spend in retirement, the next thing we want to do is figure out how do we structure our accounts with our stocks and bonds. You may be familiar with the term asset allocation. That is the proportion or ratio of stocks to bonds. Very common one going into retirement is 60-40, 60% stocks, 40% bonds. What you can see here, Jack and Michelle, that's right where they fall. But I want to take that one layer further. And I want to look at asset location, which means how do we divide our stocks to our bonds? Does it make sense to have all our stocks in a brokerage account, right? Or a Roth IRA and our bonds in an IRA? Because the question at the end of the day is how much do we want to pay in taxes? Because the distributions from those different accounts are all going to be taxed differently, right? As you'll see here on the screen, we have taxes from a brokerage account are anywhere from 0 to 15 or 20%, depending on your tax rate. Depending on if you take money out of an IRA, right, that's taxed at your ordinary income rate. And then obviously we know the granddaddy of them all, right, the Roth IRA, completely tax-free. So let's dive into this a little deeper because on the surface, 60-40 seems great. But one of the things that I found with Jack and Michelle, and I know there's a lot here on the screen, I'm going to move myself over to the top corner, is when we look here at retirement assets allocation, the current allocation, right? We have their 401k, the Roth IRA, and what I notice immediately is that Michelle's 401k has $100,000 of cash. And number two, Jack's Roth IRA has almost everything in bonds. So I have some questions there, right? And we go up to their non-retirement assets and their joint brokerage account got another $50,000 of cash. And we want to be curious about this, right? Because when it comes to building our retirement portfolio, what we're first trying to figure out and solve for is how much money do we need and where is it going to come from? And once we have that answered, then we could start to build our asset allocation and secondly, our asset location where we're going to put those stocks. Remember, when it comes to tax planning, it's not what you earn, but it's what you keep after taxes. So for Jack and Michelle, they have several different types of accounts. They have a Roth IRA, they have a brokerage account, right? That's taxable at ordinary income rates. And they have IRAs and a little bit of cash. And so what we want to figure out is which account does it make sense to draw from first in retirement for those 6 to 7 years before Social Security arrives, right? We want to keep our income low, not only for taxes, but what you'll see in just a minute as I'll wrap up the video is also for Medicare or for Affordable Care Act. This is insurance before Medicare kicks in. We want to make sure our income rate or our taxes is really, really low. So what you're going to see here on this slide from Fidelity, which I love this slide because it really breaks down the different types of taxation between each account, is where each asset belongs, right? Our stocks, our bonds, our cash, so on and so forth. So what we're going to see here is for our taxable accounts, we're going to want to hold our cash. We're going to want to hold our equity securities, right, that are for long-term growth because money coming out of this account is taxed at 15%. And then all of our income producing assets, maybe these are value stocks, maybe these are ETFs that pay a lot of dividends, or it's our bonds that earn a bunch of yield, right? We have those coupons. That's going to make sense in our IRA, right? Because that's tax deferred. We don't have to pay taxes on that till we take the money out. And then last is our Roth. Remember that one? Tax free. So we're going to want to put our highest growth oriented assets in that account. We're going to put that at the back of the line, right? Because we want to supercharge our growth inside those accounts. And so what you're going to begin to see is we can accomplish our 60-40 portfolio, but it may look a little lumpy. A lot of people think, okay, 60-40, I got to have every single account be 60-40. My IRA 60-40, my Roth 60-40, my brokerage account 60-40. But in actuality, in the case for Jack and Michelle, it's going to look something a little closer to their brokerage account, right? Maybe having an allocation towards cash that they're going to take out in the next couple of years, and then everything else is going to be stocks. The Roth IRA, 100% stocks, no bonds. And then we'll backfill whatever is left with the IRA being that last bucket. Reason this is so important, two things, taxes and insurance. Number one, we know in insurance that we're going to have two different sets of insurance after you retire, right? You're no longer on your employer's plan. And you could look at Cobra, and I'm going to record a separate video with some great insurance agents over at Move Healthcare Partners, where we get the opportunity to look at and evaluate, does it make sense to stay on Cobra? Maybe your spouse continues to work. But for this case, for Jack and Michelle, they're going to be on the Affordable Care Act, right? They're going to be on open marketplace insurance. And what we want to look at is if we keep our income low enough, we qualify for health care subsidies. These are premium tax credits. right? Again, this is going to be a longer video at a later time, but the lower we keep our tax rates, the more affordable our health insurance is until Medicare kicks in. Once Jack and Michelle turn 65, it's going to be really important for them to keep their income under certain thresholds. This is what's known as the Medicare premiums. And once our income crosses a certain threshold, even by just $1, right, we now are automatically in that tier for an entire year. Medicare looks at your tax returns from 2 years prior to determine your premium healthcare costs, right, for the current year. And so for Jack and Michelle, what we could see here, as long as their income stays below 180,000. Now this is a little outdated, and I'll have updated figures in our next video when we dive deeper into it. But what we can see, the premise still holds true. The more we make, the more we're going to have to pay in Medicare premiums, right? And that money isn't necessarily going to be out of pocket. It's going to be deducted from our Social Security, okay? And so big life events, whether it's a Roth conversion, selling a house, or in this case, taking too much money out of an IRA, right? We see this with a lot of clients. If they have all their assets just in a 401k, all of a sudden they're going to have to start taking required minimum distributions, and it just turns into a tax headache, right? And so the name of the game is staying under these thresholds, okay? Let me just share one more slide here as we update our numbers for 2024 or 2025, and we could see, right, depending on what tax bracket we fall in, if we're single or married, right, depending on how we file, we have different limits. Now, we've covered a lot, and even though videos like this are great for understanding retirement planning concepts in general, what's more important is getting a clear picture on your plan, right, and what matters to you. And if you've taken anything away from this video, it's that be flexible. Remember, retirement plans, they don't fail, they just simply adjust. Just as you saw with Jack and Michelle, options matter, right? You could work longer, you could save more, you could spend less, whatever it is, being flexible is the key to the game. Number 2, taxes matter, right? It's not what you earn, it's what you keep after taxes. Where we take our money from in retirement, which account, our Roth, our 401k, our IRA, our brokerage account, it absolutely has an impact. We got to pay attention to that. And number 3, your investment portfolio, absolutely, this is really important, needs to align with your life and your spending, right? So if we're going to need more money, then naturally we need to have a little bit of a more conservative portfolio. Now, this is exactly why I'm offering a complimentary retirement planning strategy. We know retirement planning can be confusing, but it doesn't have to be. This is where we sit down together and we discuss your specific situation and create a plan for your dream retirement and making it a reality. If you're interested, click the link below, schedule your call. We'll make sure that you have the clarity and the confidence to move forward with your retirement. Take care.